All right, welcome to session 8 of DML's small and medium-sized entrepreneurial training. We are happy to have you back with us, and we are looking forward to seeing what we will cover today, looking at money management. In our previous session, we began looking at cash journals and how to record our income and our expenses, the reasons, the importance for doing that, and how to classify them in terms of variable costs and fixed costs, and also to make decisions about how we will use the profit that we make. This session, what we want to do is to take that information that we begin to gather, income coming in and expenses going out, and now we want to do the communication part of bookkeeping, which is very important because that is where we begin making decisions based on what we are seeing in the numbers. So this is session 8, Money Management Part 2, where we are looking at the income statement and the balance sheet, which are the two primary reports that we want to use in order to communicate to ourselves as managers, as well as other people who may have an interest in how the business is doing, the communication of our finances. But we want to start today with a look at Scripture and what God has to say about some of these things. And today we want to look at Hebrews 12, verse 11, which says this: "No discipline seems pleasant at the time, but painful. Later on, however, it produces a harvest of righteousness and peace for those who have been trained by it." One thing I know about bookkeeping is that many of us don't like doing it. We don't like math. We don't like taking a hard look at the numbers. Sometimes it's easier just to not really know what's going on. But one of the things that I have seen over and over and over again, and I've been teaching people on how to make budgets, how to live by budgets, how to become financially free for about 20 years now. And the reality is that those who begin to live by that, there is a harvest of righteousness and peace. Righteousness in the fact that you feel good about how you are doing, and you are also actually able to bless people because you begin to see financial growth. But the bigger one is, for me at least, is peace. Many of us are in bondage because we are not wanting to look at the numbers. We do not want to face the reality of how we are doing financially. And our businesses suffer for that, and our families suffer for that, and the church suffers for that, and on and on. And so there is definitely peace in learning what the numbers are saying and tracking those numbers, whether it's in your home, whether it's in your business. And that in that peace comes the ability to sleep at night and the ability to rest, knowing that you are ready for what the world may bring at you, whether it's challenges in the business, whether it's challenges in the economy, because you have disciplined yourself. But we don't want to kid ourselves that it's not pleasant to go through it. There is pain in going through it, but if you want there to be growth, sometimes the pain is a critical part of that. And so we know that this may not be the favorite session for many of you, but our challenge is, if you're sincere about wanting to be a manager of God's business, that means that you need to understand these things and you need to apply it. If you're sincere about wanting to see the business grow, to be a blessing, to be empowered, to be able to help more people flourish, no, this is not something that we can ignore. You must be fiscally disciplined in business. You cannot put all your hard work at risk by not being focused on your big picture goals and your monthly sale goals. It is painful at times, but it will produce quite a harvest. And so we are saying, don't spend all your time working on your vision and your mission and your marketing if you're going to let the roof go, if you're going to not pay attention to the protecting of the business from a financial perspective, then all of your other plans are going to be for naught. And so we want to encourage you to take a serious look at this. How does doing financial reports relate to doing business God's way? And this is something that we want to think about, and the number of challenges that are there for both Christian business owners, for pastors and their budgets, for government, for education. We all have the opportunity to do either inadequate financial reporting. We also have the opportunity to do inaccurate financial reporting. And it doesn't matter where we are, that opportunity is there. And so doing business God's way means that includes a financial component to it. We don't get to just ignore that part of it. It's all part of the same package. So this is why we believe that this is so important. Tim Keller is a pastor of a very large church, and he's an author of a number of different books. So one of the books that he wrote recently is called Every Good Endeavor, Connecting Your Work to God's Work. And he says this: thinking of work only as a means of self-fulfillment and self-realization slowly crushes a person and undermines society itself. I'm going to read that again. Thinking of work only as a means of self-fulfillment and self-realization slowly crushes a person and undermines society itself. I'd like you to pause to have a discussion about this. How does thinking about work only as a means of self-fulfillment and self-realization, how does that crush a person? Oftentimes we tell people you need to figure out who you are. You need to strive for self-actualization, to do what God has made you to do. And now we're saying that when we think of work only in terms of self-realization and self-fulfillment, it not only will crush the person, it will undermine society. And so how does that work? I'd like for you to take some time to pause the video and to have a discussion about that so that we can come to a better understanding of what Pastor Tim Keller is trying to communicate. Okay, I hope you had a good discussion. One of the things that we talk about as it relates to this quote is that scientists have discovered that the real happiness comes not from money, not from simply doing good work, but it comes from being involved in something that is greater than yourself. And when we do work only for self-fulfillment and for self-realization, it becomes all about us. And my mother often told me that a person who's all wrapped up in themselves, thinking only about themselves, wrapping just like a present, makes a very small package. And what it does is it undermines the person, because we were made to be involved in something greater than ourselves. We were created to help people to flourish. And so when we're working just for ourselves, then we undermine society as well, because we are not then working to help people flourish. We are not doing our work as a way of being a blessing and being an empowerment to other people. We are trying to keep it for ourselves, to make ourselves feel good, to get money, to put food on the table. And it comes back to our purpose for doing business, which is to help our customer and our employees to flourish. And so this is important. Doing our work and being joyful in doing our work is good, but we want to continue to keep our eyes higher than ourselves, to do our work as an act of worship, with our attention on earth being on our customers and our employees. How do we help people to flourish? And that actually will give us greater joy and peace as well. And so we're moving on to the part of the business that is the roof. Again, the bookkeeping we see as part of the roof because it is what protects the business. It is what keeps the business safe from the elements, from rain, from wind, from the sun. And it also will keep things from flying out of the business that don't need to be flying out. And so the roof of the business, just as the roof of your home, is critical for the safety of the business. And so we want to move into that. We've been moving into that actually through session 7 last time. And now with session 8, we want to continue on with that. And so as we said, the two main documents that we want to look at where we communicate how we're doing in our finances is the income statement and the balance sheet. What is an income statement? Well, if you think about the name itself, it can be kind of self-explanatory. It is the statement of your income. So for a business, usually every month, a business will put out something called an income statement. Some people call it a profit and loss statement. And that describes a little further that it's talking about your profit, your sales, your revenue, and also what your loss was, whether you had more expenses than that. And so the income statement is a financial report that shows the results of a business's operations in terms of revenue, sales, expenses, and the net income over a period of time. And this is what's important. An income statement is not done for a day, usually. It's usually done on a monthly basis. You can do it weekly, you can do it daily, but most businesses do it on a monthly basis, and then they may have a summary one that goes over the period of a year. So what was the total amount of revenue in a month, total amount of expenses, and when you take your revenue and you subtract your expenses, then you will know what your net income was over that specific period of time. In session 7, we went through a weekly money management worksheet, and the items that you record in that worksheet will actually help contribute the information to your business's income statement. So if you do that daily money management on a weekly basis, that form that we looked at in session 7, then it becomes very easy for you to do an income statement, because you take those 4 weeks of information and you add them up into being a 1-month report. The income statement can reflect Monday through Friday, a period of time. Again, mostly we're talking about doing this on a monthly basis. Whereas the difference between an income statement and a balance sheet, the balance sheet reflects a point in time. Okay, so these are the two things I want to look at right now. An income statement shows a period of time. A balance sheet shows a point in time. What do we mean by a point in time? When you do your balance sheet, which is the summary of everything that your business has going on, you do it on a specific day. All right, most of our businesses are changing frequently. We can be working on our balance sheet and somebody comes in and we make a sale. And so immediately something has changed in the business again. So a balance sheet is looking at a point in time where we're saying stop to everything. Let's just get a handle on what is happening in this business right now, right at this minute or at this hour or on this day. It's kind of like, we call it a cumulative snapshot. When we take a picture of somebody, if you take a picture of me, within me is the baby that I once was, the toddler that I once was, the teenager, the young adult, and who I am today. And so there's accumulation from birth to this moment of the years and the history of what has happened to Renita, the person. The balance sheet is doing the same thing. You're taking a snapshot of the business at a point in time, knowing that things will continue to change in the business, but that snapshot shows everything that has gone on in the business, or it reflects that from the time you started the business up until today. So the income statement is a period of time, just the sales and the expenses, the revenues and the expenses over a period of time. The balance sheet is just a snapshot. It's just a point in time. So when we talk about revenue, again, we want to review some terms that we went over in session 7, just to make sure that we're all on the same page of what we're talking about. When we talk about revenue, we are talking about what the business earns by providing goods or services to its customers. Revenues earned are measured by the assets received in exchange for the goods and services, usually in the form of cash or accounts receivable. Okay, so when you are making your sales, when you are performing your services, you are given something in exchange. Most of the time, unless you're in a very agrarian culture, you receive cash. Or somebody will say, I will pay you soon, and we call that an accounts receivable. It's money you expect to receive. If you're in an agrarian, in a farming, a rural community, you may actually have an exchange where the business receives something different that the business needs in exchange for the services that you do. But it's looking at what is being earned, the revenue that's being received in exchange for services or sales of goods. Net income, then, is determined by subtracting the expenses that are incurred from the revenue that is earned. Okay, so when we say what is our net income, we are taking our gross revenue, all of the sales or services that we did in the course of a month, and we subtract from that everything that we had to pay in the course of that month in order to be able to do that business. And that's what gives us our net income. So the gross revenue, the gross income, is the income, all the sales and the revenue that we had. We subtract our expenses and we come up then with our net income. What are our expenses? What would we include as our expenses? And we talked about this last week. We talked about variable cost and fixed cost. But expenses are costs incurred by the business in the process of earning revenue. Expenses are measured by the cost of the product or service used during an accounting period. And so we want to, again, look at that same accounting period, that period of time where we're looking at our revenue. We look at the same period of time for what were our expenses. What did it cost for us to do this business? Net sales are the operating revenue earned by a company for selling its products or rendering its services. Okay, and so this is another term, another definition that you may hear as you do your accounting work, or if you're working with an accountant or a bookkeeper. We want you to be familiar with the different terms people use so that it can go, okay, I understand that, because people will use different terms to describe the same thing. Another term that people use is the cost of sales. Other people call it cost of goods sold, or COGS. All right, the cost of sales is again, what did it cost you to make that sale? The cost comprised of items such as direct materials, direct labor, excuse me, or the shipping of products necessary to bring the product to the point of completion. Okay, and so this would be your variable cost. What is your cost of sales? Helping to get that sale to the customer. What was all involved in that? Your gross profit, the difference between revenue and the cost of making a product or providing a service before deducting your fixed costs, other operating expenses. Therefore, the calculation is your gross profit is your net sales, the total amount of sales that you had, minus the cost of goods sold. That's going to give you your gross profit. Your net profit is then when you subtract your fixed costs as well. When gross profit is expressed as a percentage, it's referred to as the gross margin, which is calculated in this way. It's your revenue minus your cost of goods sold divided by the revenue. And so this is going to give you the gross profit as a percentage. What is the percentage that you're actually making in terms of a profit on your sales? Your operating expenses, that consists of your general, administrative, and selling expenses that are not directly related to the cost of sales. And so again, we would call this, another term for it would be your fixed costs. So your gross profit is looking at your total revenue, your total sales, minus the cost of goods sold. So your variable cost, that's going to give you your gross profit. Your gross profit, then you subtract your fixed costs or your operating expenses, another term, and that's going to give you then your net profit. Your fixed costs, as we said last session, is also called overhead costs, indirect costs, or your administrative costs. These are costs, again, that just to remind us, that are required to be paid at fixed amounts, daily, weekly, monthly, quarterly, semi-annually, or annually. And when we say fixed amounts, we're not saying that it's the same every time. It might be, but it also might not be. It means that they're not negotiable. These are not, your rent is not negotiable. Your electricity may vary from month to month, but it's not something you negotiate. It's something that you have to pay monthly or it will get turned off. These are costs that you pay whether you sell anything or not. These costs generally are not discretionary. You don't get the option with them. Variable costs, as we said, is sometimes called the cost of goods sold, or the direct cost or the cost of sales. All right, and that's what we were just talking about as well. So again, same term, different term, but same definition. And these are costs that vary based on sales or some other factor. You want to think of these as costs that the customer takes away with them. For example, the cost of the item used in the product you are making. So last session we talked about a tailor. What does the customer take away with them? They take the material, they take the thread, they take the button, the zipper. Those are things that the customer takes with them. Those are the variable costs. The fixed cost would be the electricity. Their customer is maybe taking the results of the electricity, but they're not taking electricity with them. They're not taking the rent of the shop with them. So the variable cost is what cost did you incur in order to sell that item specifically, directly related to the item. Ask yourself, would I spend money on this if I had no sales? If the answer is no, then it's a variable cost. If the answer is yeah, I would have to pay that even if I had no sales, then it's a fixed cost. Will costs increase as sales increase is another question you can ask. Obviously, if you are a tailor and your costs of materials are going to increase, the more sales you have, that means it's a variable cost. It varies based on sales that we have. These costs may or may not be discretionary. You may have the ability to negotiate them. You may have more input into what those costs look like than you do fixed costs, where there's generally less negotiation. And so we want to look at an income statement. And in your manual, you have an income statement in session 8 that you can turn to. Again, I'm not sure what page it is for you, but it looks like what you see on the screen right here. At the top of the income statement, you put the name of your business. So the income statement for, and insert your name. For the period of, and this is again, remember we said that the income statement is for a period of time. And so generally it's a month. You could do one for a whole year if you wanted. You could do it by the week. It's just more work. But that's where you're going to put the period of time. So the day, the month, and the year the period that you're studying. From the beginning to the end. And then you see the first column, the first set of lines, and that is where we will write in our sales and our revenue. So some of us do both sales and service, and we may have other forms of revenue as well. And so in this, we want to say during this particular month that we are looking at, how much did we earn in service revenue? All right, so our gross sales, what was the total amount of sales that we had for services that we performed? So let's think that maybe we are a hair salon. And so we cut hair, we braid hair, we do all sorts of things to hair. And so what is our service revenue? Then we want to look at, for that same period of time, our sales revenue. And our sales revenue is looking at now, how much did we sell in terms of hair products? What was our total amount of sales for the month as it relates to the different products that people might buy to put in their hair or to attach to their hair, and so on. And then the business might have some other revenue as well. Maybe the business is renting out 2 chairs in the same salon to 2 other hairdressers who are paying rent. And so that could be another form of revenue that we want to also capture. On this income statement, it's very important that you make as many lines as are necessary for your business. If you only have sales, you don't need to include service or other revenue. If you have many forms of other revenue, you may want to add different items in there. So you look for the period of time. What is the total amount of sales that you have? And then you add those 3 lines up, total sales. And now we're going to come to the next one where we're looking at the cost of goods sold, or our variable expenses. Okay, this means what did we pay for the things that the customer took with them? All right. Again, in a sales revenue, if most of our revenue is coming from sales, that's going to be a lot higher than in a service revenue. So what purchases did we make during the period of that month? Again, if we're talking about a hair salon, did we need to buy hair products for our own use as we are working with customers? Did we also, that would be part of a service cost, right? Did we have products that the customers were buying as well? What did we spend during a period of that month on our purchases, the materials that we needed in order to do the business? Related to that, maybe we had to have it shipped, and so we are paying for transportation directly relating to those products, all right? And this is where it's important that we not get confused. We're not talking about all transportation for the business. We're talking about transportation or shipping that relates specifically to getting the goods that you are selling or the services that you are rendering. In the variable cost, now you will see wages, all right? And this is only when you are paying wages based on sales, okay? So not salaries, because salaries you have to pay. It's not variable. You pay regardless of whether there are any sales. But when you're paying wages, you're paying a day laborer, you're paying based on a subcontract, When you're paying wages that are dependent on the sales or related to the sales, you include it as part of your variable cost. Otherwise, if it's a salary, then you don't include it there. And then maybe there are other costs that you are incurring that relate specifically to the sales that you are doing, the revenue that you need to include. Again, every business is quite different. So you should add or subtract lines here, as many as you need to capture a standardized income statement for your particular business. Then we add up the total cost of sales that we have, and then we now subtract the total sales minus the total cost of sales, and that will now give us our gross product. Total sales minus the total cost of sales, that will give us now our gross profit. And then we can go to the next part of the income statement. And this continues on your form for your operating expenses. What I have missing on the slide here are the lines for advertising and automobile expenses, but you can see those in your book when you look at your income statement. And now we begin to look at what are our operating expenses or our fixed costs. And so our fixed costs are the things that we pay regardless of sales. And so advertising, you might do some marketing. You might advertise and put something in a local newspaper or on the radio. And so that's a fixed cost. Automobile expenses. Maybe the business has an automobile or a delivery truck or something like that. Did you pay anything for that in the last month? Depreciation. We talked about that in the last session, and that is an important thing that we need to consider as part of our regular costs. If the customer isn't paying for it, then the business will end up paying for it. Now, here's where it gets a little tricky. You want to include this on your income statement if you're actually deducting that money and you're putting it somewhere so that when the vehicle has an issue, you can pay for that. So if you're allocating that, if it becomes a cost to you, an expense to you, then include it on your income statement. If you're just charging people for it, so it becomes part of your revenue, but you're not deducting it as a cost, then don't put it in there because you're not actually subtracting anything for it. But that's something that we'll come back to talk about how to look at that a little more later. Insurance, maybe you paid for rental insurance or for some sort of business insurance for the business in this previous period that you're looking at. Maybe you had to pay loan, and so you have an interest expense that you want to capture there. Office supplies, professional fees that you may have used. If you pay rent, again, some people pay rent on a quarterly or some even on an annual basis. If you need to set that money aside so that you can make that next payment, that's where you want to capture it. And so you report it on your income statement, and maybe both the vehicle, the depreciation, and the rent, you're putting into a separate savings account for bills, earmarked as an account where you can pay bills out of. That's when you treat it as an expense. And so it's important to do that, but don't simply record it as an expense if you're not removing that money so that it can be captured somewhere else. Repairs and maintenance. And this is where you would put the salaries that you are paying that are not dependent on sales. So that's not captured as part of a subcontractor or somebody who's doing something as a result of a contract that you may have received. Supplies, taxes that the business needs to pay, anything you spent on telephone or internet. And then the next one is transportation and travel. And this is something I want us to take a look at for a minute. There are a lot of businesses that pay their employees to come to work, or the business owner charges that expense to the business. And so that's where this would be captured. Again, it's something that you need to think about in terms of being able to reduce expenses. Is it your responsibility to get yourself to work, or is it the business's responsibility for you to get to work? And that's what gets answered by how you treat that as an expense. And that also applies to the earlier one as it relates to phone or internet. Are you charging the business for your cell phone use? How do you separate that from your personal use? Again, if you're looking to reduce expenses, and we talked about putting yourself on a salary, Does some of your phone usage come out of your salary because it's your personal expense, again, separating yourself from the business, or how much of your phone expense is something that the business should pay? This is where you wrestle with some of those things to make decisions on what is the appropriate, remembering God is the owner, you're the manager, what is the appropriate amount that the business actually spends for you to be able to allocate that cost there. And then you have your utilities, whether you're paying gas, electric, water, whatever you might be paying as a fixed cost, regardless of sales over that period of time. And then you may have other expenses that are unique to your business that you want to be able to list out. Again, this income statement has a number of different lines included, and you should only include the ones that pertain to you. So you may have an income statement that has maybe 6 lines only, because your costs, your fixed costs are few, your variable costs may be few, and so it can be a very short income statement. So make this personal to your business for what works for you. You then want to add up the amount that you have in all of your fixed costs, and then at the bottom of our spreadsheet here, our income statement, you want to have your total operating expenses, and then we want to take the gross profit. So we have our total revenue minus our cost of goods sold is our gross profit. Now we subtract from our gross profit what our operating expenses or our fixed costs are, and that will now give us our net profit. Okay, and it's our net, it could be our net income, and it may be a negative number. If it's a negative number, you put it in parentheses, and it doesn't necessarily mean that the business is in trouble if you have a negative number, and we'll talk a little bit more about that in a minute. I want us to look at this form that we looked at in session 7 to see again, how do we capture some of this information? And if you have been doing this following the end of session 7, you should already have at least a week of information generated on this form. And so in box 1, our total 1, we will capture there what our total cash in, our total revenue is. How much did we receive in sales during that week? If you've done this for 4 weeks in a row, you can simply take those 4 totals, add them up, and put that in the box for the income statement as it relates to the revenue you had. And you may have separated it from service versus sales, and so you can separate that out as well. The next one then is the variable cost, or the cost of goods sold. Now you want to look at the total in box 2. What did you spend on the things that the customers are using, the sales or the services? And again, if you have 4 weeks of this, you can add up the 4 columns of total number 2, add that up and put that in your cost of goods sold, dividing it up between the different categories that are there, whether it's your purchases, your shipping, and so on. The next one are the fixed costs, and that is the total 3 that you're looking at there. What are the total fixed costs that you spent in that particular week? And then you can look at all 4 weeks. What did I spend over the course of the month? You take those fixed costs and you can allocate them out according to your income statement. I spent this much on salaries over the course of 4 weeks. I spent so much on utilities. I spent so much on loan interest, and so on. And then the last one is something that's not actually captured on the income statement. It's going to be captured on the balance sheet. And the last one is other things that you may have purchased if you bought some equipment. Again, the income statement is a statement of income and expenses relating to doing the business. If you bought a piece of equipment, that's not really relating to your sales, your revenue, and the cost of revenue. It's relating to the business as a whole. So it's not captured on the income statement. So just to remind us that this is a very important worksheet. If you're not using this worksheet, maybe you have another system, you should be capturing these 3 items anyways. What is your revenue, the cash coming in? What is the money going out for the variable cost, the cost of goods sold? And what is the money going out for the fixed costs, the things that your operational expenses in order to operate the business? So here is an example of an income statement. This is for PW Audio Supply, and so this is a business that is doing a sales as it relates to speakers and to microphones and things like that. And so you can see here that they have a total sales revenue of $480,000. Then they want to look at their net sales by saying, okay, some people returned things, we had some sales, so we had some discounts, and so we subtract about $20,000 from our total annual sales. Now this is an annual income statement, this particular example, not a month. So for the year ended of 2012, so it's covering January through December. So they subtract $20,000 for the total sales that they had, the discounts that they had, the returns that they had, and so that their net sales now are $460,000. Okay. Now, what did it cost them to have those sales? Well, they only have the cost of goods sold listed as $316,000, so they haven't itemized it. But my guess is, given this particular business, that those are mostly for products that they bought. So they bought the products to be able to sell in their store for this audio supply place, and it cost them $316,000, probably for the cost of materials as well as the transport, the shipping. So that leaves them now with a gross profit, of $144,000. So net sales of $460,000, cost of goods sold $316,000. Their gross profit is $144,000. So that's what they have to work with now to run the business. Okay, that's their gross profit. Now we look at their operating expenses, or their fixed costs. In salaries and wages, they paid $64,000. In utilities, over the course of the whole year, they paid $17,000. In advertising, in marketing, they paid $16,000. Depreciation expense, so what they're putting aside to be able to help replace some equipment, they put at $8,000 as an expense. The freight out, so how they maybe shipped things out, I'm not exactly sure what that means for them, but it has to do with shipping, $7,000. And then they also paid insurance over the course of the year of $2,000. When they added up all of their operating expenses, it came to $114,000. All right, and so now their net profit, their income at the end of everything, their net profit is $30,000. Okay, so at the end of the year, that is what the net profit was. And that is now where we say the business has to make some decisions about what to do with that profit, whether it has to go to maybe some of their stakeholders, whether it gets reinvested in more goods, more products, so that they can have even more sales, especially if they're running short on some items. And so on. But you can see here that the income statement is laid out pretty simply from the revenue minus the cost of goods sold, or the variable costs minus the operating expenses or the fixed costs, to give you what your total net profit is, or net income is, at the end of a period of time. When financial statements are prepared, the preparation sequence suggested is as follows. The income statement is usually done monthly over a period of time, but the balance sheet is usually done annually, as well as any time you wish to get an overall picture of where your assets are in your business. For example, I recommend most small businesses that are not dealing with hundreds of products do a balance sheet on a monthly basis. When they do the income statement, you take a little bit of time to do the balance sheet. It becomes difficult to do a balance sheet if you have many products, like if you are in a pharmacy of sorts and you have many different medications, if you are in a provision shop and you have many different items that you are selling. But for most, if you have several things that you are specializing in, it becomes fairly easy to do a balance sheet, and it really is a great indicator showing how the business is doing on a month-to-month basis. What is the relationship between the income statement and the balance sheet? The income statement summarizes the results of an operating period, and those results are reflected then on the balance sheet. So the income statement tells you what happened over a period of time, and part of the income statement is what reflected on the balance sheet. But the balance sheet shows a much bigger picture of the business, and the income statement is just one small portion of what is on the balance sheet. The income statement measures the profitability of your base business based on income. And that actually reminds me, I want to take a look for a second back at this income statement. One of the things that I said was, what would happen if you are looking at a specific month and you look at your gross profit, and you then look at your total operating expenses, and you end up with a negative amount. Now, if you're doing that over the course of a year, it's problematic. But it could certainly happen in a month that you would have sales revenue, let's say, of 50,000. Your cost of goods sold, maybe 60,000. And then you have your operational expenses that you had to pay, and you end up maybe paying another 10,000 for that. And so you end up at a negative 20,000. How can that be okay? Well, one of the things we have to look at closely in an income statement is what are the reasons? And that's why the communication aspect of an income statement is so important. It could be that we received 2 shipments of our goods, so we paid twice for goods in the course of a month, where normally we pay once in a month. Maybe this particular month had 5 Fridays, and normally we buy every 4 Fridays or something like that. It could be that our operating expense, we paid a bill that's an annual bill, and so it's a larger bill. We paid it in a particular month. And that's why our sales, our net profit looks like it's at a negative balance. So it doesn't necessarily mean that there's a problem, but that's where we have to ask the question, why did that happen? Is there a good reason for it? If there isn't a good reason for it, we need to take it very seriously. If there is a good reason for it, we just need to watch to make sure that the next month we're back on track again. So I hope that makes sense. Let's go back to where we were. The balance sheet then is a reflection of the net worth or value of your business. This information is based on assets. So what are the assets the business has, the liabilities, and the owner's equity? How much does the owner actually own in the business? And so now we want to transition to look a little closer at the balance sheet. The income statement, as we said, reflects the statement of income over a period of time, but the balance sheet is a picture of the total business, assets, liabilities, and owner's equity. And so, as I mentioned, the balance sheet shows a snapshot at a point in time. To improve understanding, companies typically group assets and similar liabilities together. And so even though our businesses may be very different, the balance sheet, the income statement and the balance sheet can look very similar from business to business. The standard classifications on a balance sheet are the assets, which often go on the left, and then the liabilities and owner's equity on the right. But the whole idea of the balance sheet is that these two sides must balance. Now, balance in terms of being the same number. Often today, we see a balance sheet that has the assets listed first and then the liabilities and owner's equity listed second. It doesn't matter whether you're placing them side by side or on top and bottom, as long as those two categories match and balance together. That is what is very important. So on the left side here, we have our assets. And when we're talking about assets, we're talking about 4 different types. And we'll go through some definitions of those. But just overall, current assets, those assets are that you can quickly get your hands on. Long-term investments, so those are things that can't turn into cash as quickly, assets that the business owns. Including property, plant, and equipment are more long-term assets that we have. They're more fixed. And then we have intangible assets. So those are things that the business has that you can't even put your finger on. They are some stocks that you may own and so on like that. Okay. Then on the other side, we have our liabilities and our owner's equity. And that is where we are looking at our current liabilities. So who does the business owe money to? We have long-term liabilities. So those are things that maybe we've signed a loan agreement for over a longer period of time. And then we have the owner's equity or the stockholder's equity, depending on what type of business that you have. So let's look a little bit closer. But those are the standard classifications. We talked the other session about the classic accounting equation is assets equals liabilities and owner's equity. And so you're seeing that come back again, that your assets can only be explained in one of 2 ways: as a liability. How did you get that asset? Well, you took a loan. Or through owner's equity. And we'll talk more about that as we get into this. So let's look at some of these definitions. Current assets are assets that are cash or can be quickly exchanged for cash. This means that they are more liquid in nature. And so there are three different types of assets that we'll talk about here. But then there's a blank line if you have other types of assets as well. So one very common asset, of course, in most of our businesses is cash. All cash that the business has on hand. Okay, so where does the business have cash? In the bank, in the shop, in a safe? What is the total amount of cash that the business has on hand? Again, remember, the balance sheet is done at a point in time. So when you're doing your balance sheet, you want to ask the question, what cash does the business have right now that I'm doing this? Accounts receivable. This is money that is owed to the business by customers who establish credit accounts with the business. So you do a service for somebody, they say, I'll pay you later. That's an account receivable. That's an asset that you have. You just don't have it in your hand yet, but it's something that the business has done. You've already spent your cost of goods sold or your labor, your time for the service, and that money is expected to come. So that's considered an asset. One word of caution on that is some of us have accounts receivable and people that owe the business money, but we have no way of knowing where that person is or how we will ever find them. And so you need to make sure that you have an accounts receivable that's actually receivable. Otherwise, you need to count those as a loss. If you can't find the people, you don't know where they are, no chance of recovering it, then record the accounts receivable that you actually expect to be taken. The rest of it is going to be a loss. I worked with one business that had accounts receivable that was huge, and it was going back to the start of the business. Some accounts were 10, 15 years old and no chance of recovering that. So you need to be realistic as well as you look at the accounts receivable. And that's why we need to be very careful on how we extend credit to customers as well. The third current asset is the inventory, the stock that you have. So what is the worth of the goods on hand that are currently owned by the business, the things that the customers are going to take with them? What is the net worth, not the net worth, but what did you pay actually? What did you pay for the goods that you have in your possession that the business is going to sell? All right, not what is the sales price, because that we know isn't guaranteed, but what did you pay for them? What is the value according to what you paid? Supplies might be another current asset. If there are things that you use to run your business, for example, you do photocopying and you have a lot of paper, you have a lot of ink, and you're not selling the ink or selling the paper, you're selling the photocopies, that also becomes a current asset that you will change in. That's part of your inventory as well. And then any other thing that the business owns as an asset that can be turned into cash will be listed as a current asset. Then we want to look at fixed assets. What are the other assets that the business owns? And these are ones that cannot be turned as quickly into cash. So that would include equipment. What was the purchase price of all the equipment that the business owns, whether it's a desk, a chair, a photocopier, whether it's a vehicle or something that you're using to do the business, whether it's a machine of some sort? What was the purchase price that you paid? And don't worry about if it was 10 years ago that you bought it and you believe it's worth more now. We'll talk about those things when we talk about depreciation. For now, you want to look at the equipment and add up the total purchase price value of all the equipment that the business owns. Next is land. And again, when we talked about depreciation, we said that everything goes down in value usually, except for land. Land is about the only thing in the world that goes up in value, that appreciates. And so if the business owned land, list the current value of the land, but you can only list the current value if you are able to have it surveyed and have it assessed for what the current value is. Otherwise, you need to list the value of what you purchased that land for. And again, you may say, I got it from my parents, who got it from their parents, and we've had it in the family for 100 years. If you don't know it, then just get it assessed so that you can put a number in there. But you can't just pull a number from the sky without having something to verify that this is actually the value of the land. The third fixed asset listed there is a building. If the business owns a building, list the value of the building at the time of construction. So how much did you pay to have that building built? Or if you bought it, how much did you pay for the building and the land together? And then you can put that in as part of the asset of the balance sheet. So that's on On the left side, you continue though that you may have other fixed assets that the business owns, and you can list that there. But now this is where we come in with the depreciation. All right. And so you are looking at what was the purchase price of all the different things that you bought, and then what is their value today. So if you bought a desk and you've had that desk for 10 years, but it's a very solid desk, it has gone down in some value being 10 years old, but maybe not a lot of value. And so again, you want to take the cost, the price, divided by the duration, and that's what will give you how much it depreciates each year, so that you can assess for the various equipment that you have, for the building that you have, what could be the depreciation cost. So as I've written here, the allowance for depreciation, except for land, evaluate the fixed assets and determine their present value. Subtract this amount from the original amounts listed or the original value. The difference is the allowance for depreciation. For some people, it's a lot of work and I don't like doing math, and so I can give you kind of an easy cheat, but it's not as accurate. So let's say you have a desk and it's in good condition and you bought it for $100 and you bought it 5 years ago and you think it could last for another 10 years easily. So maybe you would depreciate it by half then, and you would just put down that minus $50. So the value of the desk is still 50. Again, accountants would want you to do this much more precisely. Our goal is not to turn you into accountants, but to get a general feel, a general assessment of the assets that you own. And so depreciation is an important part of that as well. All right, then we want to go to the other side of the balance sheet and look at the liabilities. What are the liabilities that your business owns? And so the current liabilities are those liabilities that usually people can come and knock on your door and say, I'm going to need this within the next 30 days. All right, so that would mean your accounts payable. Those are people or entities to whom the business owns a short-term debt, less than 1 year. For accounts payable, it's usually within a month. All right, so if I do a balance sheet on the 15th of the month, but I pay my salaries to my employees at the end of the month, I need to recognize on the 15th, I already have an accounts payable of 15 days to my employees, or however many days they are working. If I do my balance sheet on the 15th of the month and I pay my electricity on a monthly basis, I need to know that I have an accounts payable for about 15 days for the electricity that the business has consumed, and so on. So this may not be something that you've actually taken goods on credit and you owe within 30 days. That is an accounts payable. But it also is those other accounts that you are expected to pay when you do your balance sheet, the day that you do that. All right, so you may have other short-term liabilities. You may have a loan that you took from a microfinance institution. That's a 6-month loan. That would be a short-term debt as well. Then you have long-term liabilities. This is anything owned by the business that has a signed agreement to pay over a period of time, usually more than a year. And so this will be called a notes payable. The person cannot come to you and say, I want full payment on a given day. They have to follow the agreement that you signed together. So it's usually a debt that's owned by a bank or another loan agreement that has regular payments with interest. And so that's where you would list your long-term liabilities if you have those. The business has those, right? Then we come to the owner's net worth, or the equity. And this is, again, the accounting equation is assets equals liabilities plus owner's equity. Okay, so our assets can be explained by the liabilities we have, or our assets can be explained by the net worth. Where did this business get these assets from? Well, one thing that the owner probably did was starting with some capital. How much did the owner begin the business with? As we've already talked about in the history of the business section, see session 4, plus any more capital that the owner has added to the business. So maybe at the end of the year, the owner has said, I'm going to reinvest some of this profit back in the business, or every month you've been doing that. And so there's the owner's capital with the initial investment, and then any other injections of capital that you have put in over time. And so that's one way that the owner has some net worth, some equity. But then we have the owner's draw, and this is the money that the business owner takes from the company for personal use. The owner's draw should only come out of the profits. It's extra money that the owner takes out of the business. A lot of times we're not watching how much we're taking because if we haven't put ourselves on a salary, we're taking small every day. And so this becomes a challenge as we are trying to invest in the business and put the capital in. We need to make sure that we're not taking more, drawing more out of the business than what we've actually put in. But this is where we begin to do some looking at, we put in this amount, what have we taken out? And if you haven't been tracking it, we'll give you an idea for how you can assess that up until this point. So our net income on the balance sheet, we have a spot there where it says net income through the day now that you are doing your balance sheet. The date here should be the same as the date the balance sheet was done. Your net income here refers to the amount of income the business has made since it began. And so if you have not kept records, you can use this formula to help you come up with those answers. It is the net income. The way you can figure that out on your balance sheet is the total assets plus the total owner's draw. Okay, so it's your assets plus what you've taken from the business minus the capital minus the total liabilities. Doesn't make logical sense, but the math works. All right, so to find out what your net income is, how much money has this business made for you since you started this business, you look at your total assets, the total amount of current and fixed assets that the business has. You add to that what you believe you've taken from the business since it started. You subtract from that the capital that you put in, and you subtract also any liabilities that you have, the notes payable and the accounts payable that you may have. And that's going to give you your net income. Now, if you're saying, okay, I got my total assets, that's easy enough. I know my liabilities, that's easy enough. I also can remember pretty much what I put into the business in terms of capital, but I have no idea about the owner's draw. This is what you can do to figure that out. Just to find your owner's net worth in total, you can do owner's net worth equals your assets minus your liabilities. Okay, owner's net worth or equity equals your assets minus your liabilities. So if you don't know what you've taken and you actually don't even know what your capital has been, what you've put in, you can figure that out by taking your assets, your total assets, and you subtract your liabilities, and that will give you your owner's equity. And so that's something you can do to start with. In the future, hopefully you'll start tracking your owner's draw, because that's very important to track. You'll track your revenue and your expenses. Those are important things to also look at. But just to get you started on an initial balance sheet, that's a very easy way to get that done. And so here you have your balance sheet, and you have this in your book. You have a couple of copies here that you can use. And at the top is where you put the name of your business. Balance sheet 4, please put the name of your business as of, remember this is not a period of time, it's a point in time, as of the date that you did this balance sheet. And then you see the current assets listed on the left, your cash, accounts receivable, your inventory, your supplies. And one thing we didn't mention is the prepaid expenses. That also is an asset. If you have a phone and you bought a SIM card and you put money in that, that's a prepaid expense. That's an asset that the business should be able to claim. If you pay your rent in advance or you pay your insurance for the following year, those are prepaid expenses. You've paid them. You haven't consumed it yet. It's still an asset that the business owns, and so you want to remember to put those in. And then you see your fixed assets, land, buildings, equipment, furniture, and then your depreciation is on your fixed assets, so that's where you enter that. On the right-hand side, you see your liabilities, accounts payable, your accrued payables, like your utilities, short-term notes that you might have, and then your long-term liabilities if you have a mortgage or a longer-term loan. And then down below that, you see your owner's net worth or your equity. This is where you enter in your capital, your owner's draw, and then your net income. If you don't know your owner's capital or your owner's draw, then you simply take your total assets at C1 there at the bottom. You subtract from that your E3, your total long-term liabilities, and you put that in your total net worth on F4. All right, and then that should give you your liabilities plus your net worth should give you the number that will then equal your total assets. So maybe you're wondering why this balance sheet has an A1, A2, A3, A4, and you can see that On your on cash, it says A1. Accounts receivable says A2. And that's where we have come up with questions that can help you to do your balance sheet. And so these questions are also in your manual that will help you as you answer each question, it will tell you where to put the answer. And so we won't go through all of these, but just to start, when we're looking at cash, how much cash does the business have on hand and in the bank? Or maybe you have it in a SUSU or in a savings and loan association or a VSL or a club or something like that. You add that up and then you put that in A1. How much cash do you have on hand? The business now? Put that in A1. Then you go to the next question, accounts receivable. How much do customers owe the business for completed work? So this is work that you've done. They said they will pay you. You add that up. You put that in A2. What is the cost of inventory that you have on hand? You add up all of that inventory that you have, and you enter that in A3. And so this continues through supplies, through prepaid expenses, and so on. Then you begin looking at your fixed assets. What was the amount of purchase price for the land that the business owns, the buildings that the business owns, the equipment, the furniture and fixture, purchase price of all these different assets. You add that in up and you put it in those various line items. And then you want to look at your depreciation. Again, a very simple approach is you take the price, what you paid for it, you divide it by the duration, and then you figure out how long you've owned it, and you subtract that so that you know what your depreciation is. Okay, and all those instructions are listed there. I would encourage you to pause and take some time to go through that. Then we want to look again at our accounts payable, our liabilities. How much do you owe suppliers for inventory items that you have purchased? You place that in D1. Accrued payables. How much do you owe for operating items such as utilities or rent or payroll? Put that in D2. How much are your short-term notes? And then for your long-term liabilities, what are your long-term notes that you have to pay? And you put that in section 3. Then you go to the owner's equity. How much capital did you start the business with? How much more money have you invested? Again, if you don't know that, you can skip that part. Owner's draw. How much are you taking? Now, this is where I think it's important to take a little bit of time. It's very easy to just do the easy thing, to take your assets minus your liabilities and get your owner's equity. But I think it's very good for us to take a little bit of time to think, how much has this business given me? Maybe I've been doing the business for 10 years, and maybe on average I take 100 shillings, I'm thinking about East Africa, per day. Whatever it is that you take, try to do the math and multiply, what is this business giving you? Maybe that doesn't show up fully when you do the math in terms of assets minus liabilities equals that amount. But generally, people are very happily surprised at how this business has blessed them over the years. And so taking the time to figure out how much have you taken from the business. A lot of times I get people saying, I get nothing from the business gives me nothing. And yet they've built a house, they've sent their children to school, they put food on the table, everybody's clothed. The business is doing something, and it's good that we celebrate that and take a little bit of time to figure that out. So you can go through this formula to figure that out. How much do you estimate that you've taken from the business over the course of time? And that's not a bad thing. That's part of the reason of why you're doing business, to help maintain your family. But do some calculations of what that might be. Owner's equity, then, is your net income. Most people don't have assets, so we've just repeated this here. Your total assets plus your owner's draw minus your owner's capital and minus your total liabilities. And again, you could do this much more simply by simply saying assets minus liabilities will give you your owner's equity. All right, last session we looked at SoftBite, and specifically we laid out essentially what you see here is the balance sheet. You have the assets on the left equals liabilities and owner's equity. And you can see at the bottom that both numbers balance. The assets are $18,050. How can we explain where these assets came from? They came from the liabilities, $1,600, as well as the owner's equity, which was the $1,850 minus the $1,600. And so we have this balance sheet that is matching. But what's very interesting to me, which is why I love doing assets equals liabilities plus owner's equity, is on the right-hand side you have revenue minus expenses. And that essentially is your income statement right here. So if you can learn to do your accounting in this way, if you can learn to do your bookkeeping in this way, which takes some practice, right? And we said discipline is painful. Very easily, you're going to be able to see your income statement, revenue minus expenses, over the period of time. But you'll also be able to see very easily your balance sheet. And so it becomes very easy to take that information and to record it. And so here you have at the top, you see the income statement for SoftBite. You can see that the total income is $17,750. The drawings were $1,300. This is the owner's equity statement. I'm sorry, not the income statement. This is the owner's equity statement. The owner started by putting in $15,000, right? When the owner started the business. Additional $2,750 comes from the net income. So if we come back here, we see $4,500 is the total revenue. Find that. Subtract the expenses, $1,950. That means the total net profit or net income was $2,750. So the owner's equity now is $15,000 plus the net income of $2,750 gives you $17,750. Minus the drawings, so the owner took out $1,300. That means that the total owner's equity at the end of the month was $16,450. And now we do the balance sheet underneath that. So we have the assets. This is as of September 30, 2012. Total cash that he has on hand is $8,050. Accounts receivable, $1,400. Supplies, $1,600. Equipment, $7,000. Total assets are $18,050. Accounts payable, what he owes, how do we explain those assets? Well, he has the supplies were taken in a loan in accounts payable. So that's $1,600, and then the total owner's capital is $16,450 for a total of the same $18,050. And so that's where you can see how that statement, assets equals liabilities plus owner's equity, can help you make your income statement, know your net income very quickly, as well as very quickly be able to do a balance sheet. What would you say to SoftBite? How was their month? I'd like for you to pause for a minute and just talk about that as a group. How did he do? What would you say in terms of the first month of business that he did? What would you caution him on, or what would you encourage him on? Take a few minutes and discuss that, and then we will come back. Okay, welcome back. I hope you had a good discussion about that. Generally, I'm not sure what you came up with, but I would say looking at this business for our first month, he did well. He increased from $15,000 to $18,050. Now we have to remember that of that, $1,600 of it, $1,600 of it is a liability. So it looks better than what it actually is, but still it was an increase. Okay, he got his business set up, he got some sales, he got some initial clients. Those are all good things. The only thing I would caution him on is the amount that he took for his drawings, his owner's drawings. That might be a little bit much to do. If your net income is $2,750 and you take 13, that's a little less than half. And depending on what your goals are, if your goal is to grow the business, you might want to make sure that more than that is going back into the business to help it grow. But overall, I would say to him, he did a good job. So hopefully you came up with a similar thing. What I would like for you to do is to work on activity 2. And so where you are going to prepare a balance sheet, I would encourage you to get into small groups. And this is in your book, this is the activity, and you can work together on that. There are some spreadsheets available, again, in your workbook, in your manual, that you can use to do the assets equals liabilities plus owner's equity, and then prepare a balance sheet, all right, for Precious. These are just all the different line items, and what you're going to do for Precious, because again, everybody's statement is going to look a little bit different. But for cash, for Precious, you want to have a cash line, an accounts receivable line, a supplies line, an equipment line. That's all for your assets, your current assets. Your liabilities, she only has one liability. She doesn't have any long-term loans at this time, so that's your accounts payable. And then owner's equity is owner's capital, owner's draw, revenue, and expenses. So I'd like for you to pause and to do that activity together, and then we'll come back and look at it with the answers. Thank you. All right, welcome back. I hope that you were able to do this group together in your small group, talking about Precious Asari and her architectural firm, looking at her assets equals liabilities plus owner's equity. I want to go through this exercise now, and I hope you're able to generate an income statement and a balance sheet to give you an idea of what it feels like to go through this. Again, remember that this is unknown, and remember that discipline can be developing a new discipline can be painful, but with practice it becomes much easier. So first one is looking at April 1st, Precious invests $25,000 in cash into the business. Okay, so we would classify this as owner's capital, right? The owner is making a capital investment into the business. And how is she doing that? She's doing that with cash. So for the first entry that we have cash goes up by $25,000. And how do we explain that cash? Where did it come from? Well, we explain it by owner's capital. That's where it came from. Remember, assets tell us what the business has, and we have to say, where did it come from? Well, it either came from a liability or it came from owner's equity. And in this case, owner's equity could be the capital or the revenue. It wasn't a sale, it was a capital investment. So cash goes up by $25,000, owner's capital goes up by $25,000. Next entry is that Precious hires a secretary at a salary of $300 per week, payable monthly. Now, this is actually a trick question, right? Because she hired the person, but she hasn't paid the person. She won't pay that person until the person finishes working for 1 month. So we actually make no entry for this one. So sorry about that, but that was just to make sure you stay on your toes, that you have to identify what are the cash transactions that actually affect the business, and those are the ones that we record. So it didn't say anything about being paid, only about hiring the person, and that's a human resource transaction, not a financial transaction. Then on April 1st, Precious paid office rent in the amount of $800. And so what changed in the business when she paid the $800? Well, she paid in cash, right? So cash goes down $800. And how do we explain that? Well, it's an expense. So cash goes down $800, and we explain where that cash went because it was an expense. This was a fixed cost for the business. So we account for that in the expense column. On April 2, Precious purchased architectural tools for $6,500. She paid $4,000 in cash and then signed an accounts payable or a note payable for 6 months for the remaining balance. Okay, so she goes and she buys some tools for $6,500. She has the cash, but she decides to just give $4,000 in cash. We don't know the reason. It doesn't really matter. And she says, I'll pay the remaining $2,500 within the next 6 months. So what do we know? What did she get? What is the new asset? Well, the new asset is equipment, right? So equipment is going to go up $6,000. Cash is going to go down $4,000 because she paid it with cash. And then she also has a liability in the amount of $2,500. So our accounts payable goes up by $2,500. And so here you actually see 3 entries that are being made, but it was because she split what she owed into 2 different parts, in cash and then a liability in accounts payable. But the asset is there. So assets actually go up by $6,500, and then they go down by $4,000. And so it's a net gain of $2,500. How do we explain that $2,500? We explain it through the liability of $2,500. All right, so hopefully that makes sense. On April 3rd, Precious purchased architectural supplies on account from the Halo Company in the amount of $1,500. So now supplies are something that we consume in order for us to do our business, right? So it's probably paper, and I'm not an architect, so I don't really know. But she got some supplies for the business, and she didn't pay cash for it. She said, let me just take it on account, and I will pay you later, okay? So now she has $1,500 in supplies, and somebody coming to her business could say, where did you get this? How do you explain this asset? Well, she can explain it because it's a liability. She hasn't paid for it yet. The company that she owes the money to still has a claim on that asset. The owner does not. And so supplies go up 1,500, but our liabilities again go up by 1,500 as well. On April 10, we have a few days of silence for this business. Financially, it doesn't mean she wasn't working. But on April 10, she completed the blueprints on the carport, and she billed her client $900 for services. So she billed the client. She finished the work, but she billed the client. It does not say that the client paid yet. So now what we have is an accounts receivable. So she billed the client. She said, I did this work. I completed it. You owe me $900. So now our accounts receivable goes up by $900. That's money that we're expecting to have come in. How do we explain this accounts receivable, this $900 that we're waiting on? Well, we explain it by a revenue. We did a service in this case, and the customer needs to pay. On April 11, we received $2,500 cash from our wealth for the design of a new home. Okay, so again, she did a job for somebody, designed a new home, and they paid. This time they actually paid the cash, $2,500. So cash goes up $2,500. How do we explain this asset? Where did this cash come from? Well, it was a revenue, right? We did a service and the customer paid, so our revenue goes up $2,500. On April 20, we received $1,500 cash for services completed and delivered to P. Donahue. So now she has a third customer. She's not doing too bad. On April 20, she received $1,500. So her cash again goes up $1,500. How do we explain this cash that came into the business? We explain it by a revenue. We did a sale, the customer made the payment, and $1,500 shows up as part of our revenue. At the end of the month, now it's April 30, we hired the secretary on the 1st, we're paying the secretary on the 30th. 4 weeks at $300 is $1,200. So now our cash goes down $1,200. How do we explain where did this cash go? Well, it was an expense. The business had to pay an operating cost, a fixed expense, the amount of the salary. And so we show that expense as minus $1,200. And lastly, we paid the Halo company $600 for the accounts payable due. And so if we look on April 3, we bought some supplies. Now we make a payment on those supplies. We pay Halo company $600. So our cash goes down $600 and our accounts payable goes down $600. But in addition to that, on April 30, we have two different transactions that happened. All right, we also looked at the supplies that we bought. Okay, we bought these supplies and we realized that in the course of the month, we consumed about $600 worth of those supplies. And so we are going to subtract $600 from our supplies. And how are we going to explain that? Well, that becomes an expense. It's a cost that we paid in order for us to do business. Now, you could do this on two different lines if you wanted to, but you can see that on the left-hand side, it says on the 30th, if we were to look on what happened on the 30th, we would see two different entries there. We paid the Halo company, so our cash went down, but our accounts payable also went down. We also looked at the supplies and we said, we really can't say we have $1,500 in supplies anymore. We've consumed about $600 worth, so we're going to subtract that from our supplies and acknowledge it as an expense for the business. All right, so when you go back over each of these columns now, cash, we started with $25,000, we subtract $800, we subtract $4,000, we add in $2,500, we add in $1,500, we subtract $1,200, subtract $600. It gives us $22,400 for what we have for cash. For our accounts receivable, we have $900. We're still waiting for that customer to pay. For our supplies, we had $1,500. We consumed $600. We now have about $900 worth of supplies. Our equipment, we're not depreciating yet. We'll do that when we actually do a balance sheet. So we started with $6,500 and we still have the same. Our accounts payable, we have two different accounts that we owe on, and we made a payment on one. We have a total of $3,400 that's owed. Our owner's capital, we started with $2,500. We didn't invest any more in. The owner's draw, we didn't take any money. Precious didn't take any money for herself. She had a total revenue of $4,900 in three different services that she performed. And then expenses, she has a total of $2,600 in expenses. When we look at the rent, we look at the salary, and we look at the supplies that were consumed. When we add those up, the assets, remember, should equal the liabilities and owner's equity. When we add up on our asset side, our cash, our accounts receivable, our supplies, and our equipment, we get $30,700. When we add up our liabilities and our owner's equity, we also get $30,700. And so it balances, it's reconciled. You'll hear about accountants talking about reconciling. Sometimes you add it up and it doesn't match, and you go, what did I do wrong? Where did it not match? And so then you try to go back to see where the problem was. When we then look at the income statement for Precious, we would say that her total revenue, she had three different services. Remember that we said $900, $2,500, and $1,500. Her total revenue, service revenue, was $4,900. Her total expenses, she had salary, she had rent, she had total expenses of $2,300, and her net income then is $2,600. All right, so when you go back, let me go back here. When we take a look at the income statement then for Precious Asari, we see that this is over the period of April 1 through 30, whatever year, 2016. Total revenue, she had three sales, three customers, for a total revenue of $4,900. For her expenses, she had a salary expense of $1,200, a rent expense of $800, and a supplies expense of $600, for a total expenses of $2,600. And that gives us now a net income of $4,900 minus $2,600, a net income of $2,300. And so all of this can be taken. Let's go back here for just a minute. Sorry. We flip through this. All of this can be taken, as you can see, from this very last two columns that we have here, the revenue and the expenses. And so you can see $4,900 was the revenue from three customers. The expenses was $2,600, and that's what leads us to be able to come up with this balance, this income statement very easily of a net income of $2,300. Then when we go to the balance sheet, it's as of April 30, so she did it on the last day of the month. Total assets, cash, and all of this was taken back. If we go back to that chart again, which I won't do, but hopefully you have that in front of you, you can see her cash was $22,400. Accounts receivable was $900. Supplies that she had left were $900. Equipment, the tools that she purchased, were $6,500. Total assets was $30,700. On the liabilities and owner's equity side, we have a liability in the amount of a notes payable for $2,500 and a second accounts payable in the amount of $900 because she made that one payment on the supplies. Then we have total liabilities, therefore, is $3,400. The owner's equity then is the capital she invested, the $25,000, plus now the $2,300 that she had in net income, for a total of $27,300. When we add the liability and the owner's capital together, we get a total of $30,700. And so this is how her balance sheet is laid out. We only include those things that are relevant to this particular business. We need to make sure that it balances. In your book, you'll see another activity that you can work on your own. And as an assignment for this week, we would like for you to do that. And this is for Theo Davis, who opened Davis Deliveries. And so go through these and enter them into your same assets equals liabilities plus owner's equity. And we would like for you to then create an income statement and a balance sheet. And again, this is going to take practice to do this. And so we encourage you to take your time to maybe do this with a partner, work together on it, see if you can get it to balance. And if you can't, that's okay. We'll come back and talk about it. But we would like for you to do that as an example of practice. And then next time, we will show you the answers for that. We won't do that for today. But this is good. You can continue to track your income and your expenses for your business. And maybe you can begin to even do this in the format of assets equals liabilities and owner's equity. Get yourself more familiar with that so that it becomes easier for you to then make your reports and to do some assessment on that. All right, that's all for this session. Next session, we will begin looking at marketing and installing some windows and a door in your business so that you can attract customers. Thank you so much. May God bless you.